This week, Tesla slashed the price of its Cybertruck with a catch that has investors talking. The move comes as the company officially begins sunsetting its flagship Model S and Model X cars to make way for humanoid robots. Is this a sign of desperation as vehicle sales falter, or a calculated high-stakes pivot to an entirely new future? We'll dig into the details. Welcome to TickerWatch News for Tesla, Week 8, 2026. This episode covers the major news and market developments for Tesla as the company navigates slowing EV demand and accelerates its push into artificial intelligence and robotics. In a challenging period for Tesla and the broader tech market, while specific weekly numbers weren't the focus, the larger trend shows the stock is down around 8 to 9% year-to-date. This performance is part of a wider sell-off in so-called Magnificent Seven stocks, which saw their collective market value shrink by over $1 trillion through mid-February. The tech-heavy Nasdaq has also been under pressure, down over 3% for the year. The takeaway is that investor sentiment around Tesla is complex, balancing concerns over the core auto business with long-term bets on the company's ambitious future. This week saw several major stories emerge, painting a picture of a company in deep transition. First, Tesla made significant pricing changes to its Cybertruck lineup, fueling speculation about demand. The company introduced a new dual-motor, all-wheel drive version of the truck, priced at $59,990, making it the most affordable Cybertruck to date. However, CEO Elon Musk announced this price was only valid for 10 days. In a more permanent move, Tesla cut the price of its high-end Cyberbeast model by $15,000, bringing it down to $99,990. These adjustments follow reports of lagging sales, with some data suggesting Cybertruck sales are well behind competitors like Ford's F-150 Lightning, and that the vehicle is depreciating faster than typical pickup trucks. The second major story is the acceleration of Tesla's strategic pivot away from being just a car company. It's now official that production of the Model S and Model X, the vehicles that first brought Tesla to global prominence, will be discontinued. The factory space in Fremont, California, is set to be converted to manufacture the company's Optimus humanoid robot. This move underscores a fundamental shift in focus toward robotics and artificial intelligence. Underscoring this, capital expenditures are expected to more than double in 2026 to over $20 billion to fund new factories and AI infrastructure. This pivot comes as Tesla reported its first-ever annual revenue decline in 2025. Third, there were key developments around Tesla's full self-driving or FSD technology. In the US and key markets, new customers can no longer buy FSD as a one-time $8,000 purchase. Instead, it's now a $99 per month subscription, a move that shifts a key feature into a recurring revenue model. In related news, Tesla avoided a potential 30-day sales suspension in California after it agreed to stop using the term autopilot in its marketing in the state, instead referring to its system as supervised. This resolves a multi-year dispute with the California DMV. Alongside these changes, Tesla released new data indicating its FSD system has now driven over 8.2 billion miles, with the company claiming a significantly lower collision rate than the US average. Finally, Tesla's making a global push for talent and technology to power its AI ambitions. The company launched a direct recruiting campaign in South Korea to hire AI chip design engineers. This signals a drive to bring more of its specialized semiconductor development in-house as it aims to create its own 2nm chips for autonomous driving and robotics. In a related move, the Federal Communications Commission granted Tesla a waiver to use ultra-wideband technology, which will aid in the precise positioning needed for wireless charging of its upcoming Cybercab robotaxi. The market is divided on Tesla's path forward. This week highlighted a growing tug-of-war between institutional and retail investors. Filings revealed that major funds like UBS Asset Management, Nomura, Goldman Sachs, and Morgan Stanley all reduced their stakes in Tesla in the fourth quarter. In contrast, data shows that retail investors are continuing to buy the stock, seemingly embracing the long-term vision of Tesla as an AI and robotics powerhouse. Analyst ratings reflect this split. Tiger's Financial initiated coverage with a buy rating and a $550 price target, focusing on the company's evolution into a physical AI platform. Benchmark also reiterated a buy rating. However, other firms are more cautious. Wells Fargo maintained its underweight rating, citing weak delivery data in early 2026. JP Morgan also reportedly cut its price target, concerned about declining deliveries and potential brand backlash. The consensus price target among analysts sits right around where the stock is currently trading, suggesting the market is collectively in a wait-and-see mode. From a technical perspective, the stock is at a pivotal point. Its prior uptrend that began last spring has been broken, a potentially bearish signal. However, shares have recently found support near the $390 to $415 levels, an area that has previously attracted buyers. The 200-day moving average, another key indicator, is reported to be around the $386 mark. The stock's ability to hold these support levels will be watched closely by traders. On the fundamental side, valuation remains a primary concern for skeptics. With a forward price-to-earnings multiple reported to be in the high 200s, the stock is seen as being priced for perfection. This valuation is set against a backdrop of a business in transition that recorded its first annual revenue decline in 2025 and second consecutive year of falling deliveries in 2025. The plan to more than double capital spending this year for robotics and AI initiatives adds another layer of risk, as it will weigh on free cash flow in the near term. The core debate is whether the potential of future businesses justifies the premium valuation while the established car business is slowing. Looking ahead, several factors could influence Tesla's trajectory. The company has stated that production of its purpose-built robotaxi, the Cybercab, is set to begin in April. Any updates on this ramp-up, which Musk has warned will be agonizingly slow at first, will be a key catalyst. On the competitive front, rival Rivian is set to reveal more details about its upcoming R2 SUV on March 12th, which is aimed at the same mass-market segment as Tesla's popular models. For investors, the key price levels to monitor are the support zones around $390 and the 200-day moving average near $386. A sustained break below these levels could signal further downside. The bull case scenario is that the market continues to look past the weakening auto sales and focuses on the AI and robotics narrative, supported by positive news on FSD adoption or Cybercab progress. The bear case is that continued weak delivery data, particularly from China, and the high cash burn from new investments will cause investors to lose patience, pushing the stock below its key technical support. The most likely scenario is continued volatility as the market digests the competing narratives of near-term challenges versus long-term transformation. Thank you for tuning in to TickerWatch. This podcast is for educational purposes only and is not financial advice. Be sure to subscribe, leave a review, and share this episode. We'll be back next week with another update.